Hey everybody, back with another video, and today I'm going to be going over my current 2023 portfolio allocations. Thought it'd be a good idea to go over this since I did just put up the video talking about where you guys could think about parking your cash. So this quite literally lets me put my money where my mouth or where my videos are. So we're just going to go over the allocations, the returns, a few other simple things relating to it, not a bunch, but without further ado, let's get into it. So as you can see here with our simple pie chart, I have my allocation. Only 3 real asset classes for this, so it is quite simple. As we can see here, the biggest one is going to be savings, sitting at about 60%, 61% to be exact. Then we have a money market fund. In this case, it is the VMRXX that I showed on the previous video. Again, it could be any money market fund. This is just the one I chose. It works for me. That's at about 30%. And then lastly, we have I-bonds sitting at about 9%. If we wanted to make this a lot simpler, we could just call this 60, 30, 10 to add up to our 100%. Much simpler math. And when talking about this, I also, a little bit of transparency, this is not a tiny fraction of money. So, a lot of people say, well, you're only talking about, this is $1,000. So it doesn't matter if, you're invested in bonds or stocks because a 4% return versus a 10% return is only $40 versus $60. So, stuff like that. I will say that this is an amount of money that if I were to walk into a financial planner's office and they saw 60% in savings, they'd probably say that 60% needs to be in equities because you're not getting enough return. It's enough money to where if a financial planner saw these pie slices for the amount that I have, they'd call me crazy or hyper conservative. You're going to lose out on tons of returns over years, that kind of thing. So just keep that in mind. This is very much a money where my mouth is kind of thing. Looking at our return, we can see that our savings currently paying right at 3.4%, which is right around the average of what your high yield online savings is going to do. As I said before, you can probably find a little bit better than this, but the bank that I use works for me. It's the one that I choose, but you can do a little bit better than that. I probably could if I wanted to, but I like the one I'm with. As far as the money market fund, it's currently right at about 4.5%. That rate's going to go up a little bit more and does technically fluctuate every day because of the way the rate is calculated, but it is right at around 4.5%, which was the one that we looked at earlier, as I said before. And lastly, for our I-bonds, this one's a little bit more confusing because of the way you all know that I-bonds work. The overall rate is about 7.5%. I have some that are at different rates, but taking all of the rates and averaging them together gets you to right about 7.5% weighted. So yeah, that's for the I-bonds, about 7.5%, which gives us a total rate of return right at 4.1%. Now, for a lot of people, they look at 4.1% and say, that's nothing. I can get so much more in equities. Even with certain like corporate bonds, high yield bonds, I can do so much better than 4.1%. But with this allocation, you have to remember that this is what they would call hyper conservative. All of these are either insured or super low risk debt. We have our savings, which is insured. We have our I-bonds, which is, backed by the U.S. Treasury. And then we have our money market fund, which is made up of short-term treasuries, repurchase agreements, things like that. So again, either backed by the Treasury or ultra low risk. So this is essentially a risk-free return of 4.1%. That is to say, there is essentially no risk involved like this. Now, if I wanted to be a little bit more risky, we could look at the S&P, for example, which so far this year has returned about 7.5%. And, just looking at the numbers without any context, someone could just say, I can do almost twice as much with the S&P. Why wouldn't I do that? That, again, comes to risk. The S&P, highly volatile. We're in a highly volatile environment currently. Is it worth it to, do 3.5% better return while risking, whatever amount of money you have? For me, quite a bit of money. Not rich by any means, but this is not an amount of money where I could risk it and be okay with losing it, whereas I can get a risk-free return of over 4%. I could make that even more if I wanted to cut out half my savings here from 60 down to 30 and throw another 30% into the money market. That total rate of return is going to jump up to probably right at 4.5%, maybe just under that, maybe 4.4%. So I could do about 0.3% better. But, this is just the allocation that works for me. Over time, this is going to change a little bit. As my savings has gotten to a number which I'm very comfortable with, everything in excess of that is going to go into the money market fund, as well as some other things. I'll probably be looking at some short-term treasuries because they're currently doing very well. 1 month sitting at 4.6%, which is doing even better than the money market rate. There are some CDs, as I showed you earlier, that are getting in excess of 5%. So again, this current portfolio is what I'm sitting at right now. In the future, it's going to be similar to this for the near future, and even in the far future, it's not going to be much different, but there are going to be some slight changes. But in the current environment, I am still staying with this hyper conservative portfolio. No equities, no corporate debt, no long-term U.S. debt, unless you considered I bonds long-term debt. But like most of you, I won't be holding these for the full 30-year maturity. Probably won't even make it to 5 years. The other thing to think about is how this is going to change with rates. Rates are going to keep going up no matter what. It's just a matter of how high are they going to go. Are we going to top out at a Fed funds rate of 5%? Is it going to have to go to 6%? Is it going to have to go to 7%? Things like that. So that 4.1% is definitely going to jump. The savings rate is going to go up probably with the next interest rate increase, at least 0.1%, maybe more than that. The same for the money market funds. They are going to increase their rates at least a little bit. So that 4.1% is likely going to turn into 4.25% or a little bit more than that over the next 30 to 90 days. And then after that, depending on where inflation is and where the Fed fund rate gets, it could get even higher than that. So again, ultra conservative portfolio, still giving a decent rate of return. 4%, 4 to 6% is what bonds do over the long term, depending on which bonds you look at. Some people say it's more like 5 to 9%, but it really depends on what duration. Considering these are short duration bonds and even not even bonds but savings, I'm essentially doing better than bonds do over the long term. So with this is good for me. It works for me. This lets me sleep at night. I'm getting a rate of return without any risk in an environment that is very risky, and that's risk-adjusted returns. For me, this is an amazing risk-adjusted return because there's essentially no risk adjustment. The risk is 0, so it's just 4% essentially. I'm getting 4% back on my cash in a market where I could lose 30% next week if the right circumstances happen. So, just a little overview. You don't have to set up a portfolio like this. Just wanted to show you what mine looks like so that, the stuff that I'm spouting isn't, completely contrary. I'm not 100% in Tesla or some meme stocks while I'm telling you guys that you should definitely have a savings account and look at money market funds and I bonds and short-term treasuries. I am very much doing what I preach. At least I try to, as close as possible. So yeah, that'll about do it for this one. As always, thanks for watching, and I will see you all next time.